All right, let's get right into it. We hear this all the time, right? The idea of bringing banking to everyone, financial inclusion, is often talked about like it's a magic wand for solving poverty. But what if that very same push could actually create the conditions for a major economic crisis? Well, today we're going to explore that exact balancing act, and we're using Indonesia as our guide.
To really get a sense of what we're talking about, let's just start with a number: 197 million. Back in 2011, that's how many people in Indonesia were completely unbanked. I mean, no bank accounts, no access to credit, no insurance, nothing. It's a huge, huge challenge, but it's also a massive opportunity.
So first things first, let's make sure we're all on the same page. When we say financial inclusion, we're talking about making sure everyone can get their hands on useful and affordable financial tools. Think savings accounts, small business loans, that kind of thing. Financial exclusion is just the opposite. You're locked out. And really, it's the difference between having the tools to build a better life versus being stuck in a cash-only world, which, makes it incredibly hard to do anything from starting a business to just planning for the future. And that brings us to our first big question. Why does this financial divide matter so much? I mean, why should we care if someone has a bank account or not? Well, it turns out the stakes are incredibly high, not just for people, but for the entire country. This right here gets at a really powerful economic idea called supply-led growth. The thinking goes, you don't wait for people to become wealthy enough to need a bank. You give them the banking services first, and that actually sparks the growth. Give someone access to credit, and they can expand their small business. Let a family open a savings account, and they can start putting money away for their kids' education. It really shows you that deep connection between having access to finance and actual human development. It's not just about money. It's about giving people the power to build their own futures. Okay, so let's move on and see how this actually played out. Indonesia's attempts to solve this problem has been a real roller coaster, stretching over 4 decades. It's a pretty dramatic story that takes us from total state control all the way to the smartphone that's probably in your pocket right now. This timeline really shows the policy whiplash the country went through. First, you had the government basically deciding who got cheap loans. Then, in 1988, the pendulum just swung completely the other way. Total deregulation. Well, that experiment ended in an absolute disaster with the 1997 Asian financial crisis. It was a brutal lesson about what happens when credit expands too fast with no rules. That forced Indonesia to get really serious about regulation. And all of that leads us to today, where mobile connectivity is just changing the entire game. And this is what that new game looks like. Now, don't worry about trying to read all the Indonesian here. The big takeaway is that it's not just one person in charge anymore. Right at the center, you have this national strategy that links up the central bank, government ministries, private companies, tech firms, even academics. It's this massive, coordinated effort to finally crack the code on how to include everyone, but to do it safely. Which brings us to a really fascinating part of the story, and the central paradox here. Because while everyone wants all the good things that come from financial inclusion, getting there can be a very, very risky business. If you're not careful, the push for progress can actually create the very instability you were trying to fix. Think of it like a coin. On one side, you've got the incredible promise of inclusion, all those amazing benefits we just talked about. But flip that coin over and you see the danger. High-risk lending, asset bubbles, bank failures. This should all sound pretty familiar, right? It's basically the story of the 1997 Asian crisis and the 2008 global financial crisis. The very act of giving credit to millions of new people who are often riskier borrowers can push the whole system to its breaking point if you don't have guardrails. But the plot thickens here. Beyond the risk of a full-on financial meltdown, researchers in Indonesia found something else, something a little more subtle. What if the big push to include the poor was, somehow, actually making inequality worse? These charts tell the whole story. It's a real paradox. On the left, we're looking at account ownership by wealth. And sure, everyone is doing better by 2017. But look at how much faster the orange bar, the richest 60%, is growing compared to the blue bar for the poorest 40%. The chart on the right, same story, but for education. People with more schooling are just leaping ahead, leaving those with less education further behind. So what in the world is going on here? This quote from the research paper is pretty much the key. It explains that how you try to achieve inclusion matters a lot. If your policies are all about making it cheaper to borrow money, you mostly end up helping people who are already in the system. The richer, more educated folks. To really help the people at the bottom, you have to focus on making it cheaper and easier to just get in the door, to open that first account. And that brings us to our final act, the balancing act itself. How did Indonesia learn from all these mistakes to build a system that could bring more people in without causing a meltdown or making inequality worse? Well, they wrote a brand new playbook. Yeah, after the '97 crisis, Indonesia got very serious about regulation. This playbook here is the foundation of their modern, stable system. They made banks hold more of their own money as a safety cushion. They cracked down on risky insider lending. They forced banks to plan for bad loans. Basically, they built a much, much stronger financial house before they invited millions of new people to move in. This is exactly what a tight regulatory regime looks like. And this, right here, is the big punchline of the research. It tells us that strong rules and financial inclusion are not enemies. In fact, it's the opposite. Things like requiring banks to have plenty of capital and enough cash on hand, those are the things that make it possible to safely expand financial services to more people. A tough regulatory system doesn't block inclusion, it enables it. You can and you absolutely must have both. And hey, the proof is in the pudding, right? This balanced approach worked wonders. Between 2011 and 2017, the number of people with accounts more than doubled. And get this, here's a really amazing detail. By 2017, financial inclusion for women had actually overtaken inclusion for men. By creating a stable, safe environment, Indonesia didn't just boost inclusion, they made incredible progress on gender equality too. So we'll end with this thought. Indonesia's story is a really powerful lesson. But as technology, especially our phones, makes everything happen so much faster, literally putting a bank in every pocket, this challenge just gets bigger. And the core question is still there, for every country out there. Can we keep chasing the incredible opportunity of financial inclusion while also managing the constant risk of instability? The balancing act, it seems, never really ends.